one of the reasons that I got into all of this in the beginning was because of the Cyprus Bank bail-in, when you realized that the dollar was not your dollar, right? It was lending money to the bank, which is what is happening with Circle and Tether. And people aren't realizing they're repeating the same thing. And this is a really important point that doesn't matter until it really fucking matters. That, I think, is where the network effects, and it's the second side of your business, which is tokenization, right? These networks can be used for tokenization of anything. So, i.e., anything can be wrapped and moved around the system. And I think this is still not fully appreciated yet. Yes, Figure are trying to do some stuff. People are doing stuff, but people have no idea the size of these markets, which is the equity market. The DTCC do, I don't know, $4 quadrillion of settlements.
Hey guys, welcome to Everyday Finance. Raoul Pal delves into the most recent spike in Bitcoin's value. It's arguing that its success might be attributed to broader market momentum and significant improvements in global trade. With the United States obtaining a comprehensive agreement with the European Union and Japan while simultaneously lowering tensions with China, risk assets skyrocketed in value. The S&P 500 began at new record highs, while Bitcoin surged beyond $12,000 before settling near $19,000. This is a level that continues to keep bulls enthusiastic about the possibility of retesting all-time highs. Cryptocurrency analysts are focusing their attention on critical thresholds. If Bitcoin is able to maintain its position above $117,000, it may initiate another big leg upward. But if it falls below $113,000, it runs the risk of losing momentum. On the other hand, macro headwinds are building up as traders assess both outcomes. The GDP statistics, a decision from the Fed about interest rates, and the PCE inflation report are all expected to influence markets. Jerome Powell is under a great deal of pressure, and any indication that he may reduce interest rates could completely alter the direction of Bitcoin in the stock market.
Yeah, and on the flip side, we all own Bitcoin, and that goes up when they keep debasing the currency anyway. So there's the kind of whole game is to be played here, and it's all set up, the infrastructure for that. I've always thought it was a transition to a new system, and as part of that transition, you're debasing the old system, but you've got the life raft, which was Bitcoin, and now you've got the way of changing the system to the better to get rid of the flaws. Here's a question for you that's interesting to me, and I want to get your thoughts on it. Circle is trading at an enormous valuation suddenly. And to me, it's either because everybody's an idiot or we're missing the fact that there are network effects at play here. And I'm just thinking for you as well, is like, you're talking about the infrastructure to build on, but it's what builds on the network that creates the actual value of the network in the end. Is that what you think is going on here, that people are extrapolating out?
I think there's definitely elements of that. I mean, it's very interesting to see at one point, it had I think a bigger market cap than Coinbase.
It's got a bigger market cap than its stablecoins.
Yes. I mean, it's like, yeah, I mean, so you're certainly discounting an enormous amount of growth and network effects and the ability to monetize those network effects. I mean, that's what the market has to be doing. It's always hard to comment on exactly a competitor where the market is.
For you, in your shoes, you either think, okay, it's a bad signal and people are just getting delusional, or, okay, if the market's telling us there's potential a lot of network effects, then what does that mean for Paxos?
By the way, I think it's probably both. You know what I mean? Just like anything. The markets get over exuberant and you have technical effects because there's so much of the supply is locked up and, you can't even get a borrow and other things. So it doesn't take a lot for it to become almost get a meme stock effect for periods of time. So there's probably some elements of that, but obviously it's also telling us something about network effects, in my opinion. And I think that's also, in some ways, showing how valuable a network is and why you want to actually have it set up in a way where you have infrastructure enabling the network where the economics are shared amongst everybody, because it's going to be so valuable. You want to be able to participate in it. And so you want there to be something that is neutral. And I think that's what, we consistently hear from people. That's why MasterCard joined, and that's why Fiserv or WorldCoin, WorldPay has joined, and Robinhood, like lots of big companies that use stablecoins or are in payments. They're trying to think about, well, how do we make sure that we set up the right foundation if this is really going to be as transformative as everyone is talking about and as they think. And I certainly think that if you don't set it up the right way, then it would be really unusual situation to have one or two firms take all of this opportunity from very large incumbents that could very easily sit here and adopt something that would change that.
And also, to your point, the reason, one of the reasons that I got into all of this in the beginning was because of the Cyprus Bank bail-in, when you realized that the dollar was not your dollar, right? It was lending money to the bank, which is what is happening with Circle and Tether. And people aren't realizing they're repeating the same thing. And this is a really important point that doesn't matter until it really fucking matters.
And by the way, it almost did. When Silicon Valley Bank failed, they were the single largest creditor, $3.3 billion to Silicon Valley Bank. And, essentially, if the government had bailed out Silicon Valley Bank, which was bailing out Circle, they would have failed. And, that's a kind of an amazing thing. But the network effects are so strong, and there were so few alternatives that, they've been able to push through that effect. But that's why the legislation is important, because it's getting rid of this regulatory arbitrage that they're both existing in to this day, which is that they're basically issuing zero-cost debt. And no one fully realizes that that's actually the implication when you hold it, that you've made a loan to it. But if you went on Coinbase's books and you look at their 10Q, guess what? It shows a loan to Circle. It doesn't show USDC. It's a loan to Circle. That's what USDC is. By the way, that's the same thing with Tether. And it doesn't mean that they're not fully backed. It doesn't even mean that they're going to fail. It just means that your relationship with them is different than it appears. And the whole point is legislation and the way we're running things are going to shift that dynamic. What's so interesting about like a dollar stablecoin is ultimately it's a wrapper. And the dollar is a wrapper, theoretically, for T-bills. You could make it a wrapper for a lot of other things like Maiden Lane and a sieve and corporate debt, which the Federal Reserve has periodically put onto its balance sheet. But it basically should just be T-bills. It's actually really simple. By the way, it used to be a wrapper for gold. And it was a wrapper at $19, then 23 or 24, and then 30, whatever it is, and they got up to $43 or something. You can always go back to the dollar being a wrapper for something else. So going back to your end game point, how does this end? You could very well end where the dollar is now a wrapper for Bitcoin and gold and T-bills, or just one of them, whatever it might be, or maybe not, right? And, something else altogether happens. But the dollar's just a wrapper.
That, I think, is where the network effects, and it's the second side of your business, which is tokenization, right? These networks can be used for tokenization of anything. So, i.e., anything can be wrapped and moved around the system. And I think this is still not fully appreciated yet. Yes, Figure are trying to do some stuff. People are doing stuff, but people have no idea the size of these markets, which is the equity market. The DTCC do, I don't know, $4 quadrillion of settlements.
On-chain data implies that Bitcoin's surge may be running into liquidity limits. Despite the fact that the overall environment is optimistic, flows of stablecoins, which are an essential source of purchasing power, have begun to decrease, which has the effect of lessening the amount of fuel required for continuous upward. Because of this decrease in fresh liquidity, traders may need to adjust their expectations in order to account for the increased likelihood of a short-term cooldown. The data suggests that Bitcoin may consolidate or even retrace before any larger move resumes, despite the fact that bulls continue to maintain their optimism regarding an imminent breakout. As global macroeconomic uncertainty continues to grow, traders are bracing themselves for volatility. This uncertainty includes rate policy moves as well as inflation indications. It is possible that the next direction of the market will be determined by the rate at which liquidity recovers and whether or not institutional flows can intervene to stabilize momentum.
So that's the question, what do you pay for this? How long is this arbitrage of, people like Tether's the world's most valuable company? No, it's borrowing money at zero interest and receiving interest. It's just an interest rate arb in gigantic size. So it's free money.
Yes.
But that's got to get competed away very soon, right? Because you guys have, and several others have got kind of interest-bearing stablecoins, but you've not been allowed to use them in the US.
Yes, or you set up something like the Global Dollar Network where you can pay out the interest at least to the intermediaries. I personally think a interest-bearing stablecoin is exactly where you want to get to, because you shouldn't just be democratizing access to dollars, which is what a stablecoin is doing. You should be democratizing access to the risk-free rate. In what world should the wholesale rate be 4.25 and the retail rate is 0 to 2%? There's no way that should be completely compressed. In every other industry, the internet has completely compressed the spread. And if you actually think about lending money to a bank, especially once you're over a $250,000 FDIC limit, you are taking on credit risk. You should be getting paid more than the risk-free rate unless you're getting services that you value and are willing to take less. But you should be able to make sure that everyone gets the risk-free rate as the base rate, not just very sophisticated people. I actually think it's like profoundly undemocratic and like completely a poor social and economic policy for us not to make it easily and readily available, which you can do with the new technology. It didn't exist before. That's why it was that way. Now it should be available. But the current stablecoin bill doesn't make that possible. Maybe the market structure bill will. And I think when you get to that point, in the case of, Circle or anybody else, Tether, they're doing a great job of going out to people who don't have any access to dollars. You're in like the Maslow hierarchy of needs, of the monetary Maslow hierarchy of needs. You're like, I just want dollars. I don't care about anything else. Getting dollars to me is better than nothing. You get dollars. And, you might not be getting interest back from the issuer, but that's okay. You have the dollar, and maybe you can go into the DeFi ecosystem or the centralized exchanges, and they'll give you a yield on it anyways. And so, you're kind of like able to mask, at least for some time, that the issuer is keeping a big chunk of interest. But I wonder how long that will last for. And in certain cases, you see like there are really big deals that are being done with individual distributors of stablecoins because there is pricing pressure that's creeping in. I think like the V2 or V3 model of stablecoins should be all the interest is going back to the end user. Right? I mean, and maybe if you have a retail user in like, I don't know, Chile or something, and they can't get dollars and, they're fine with no interest, you always have something that you're collecting. But it should, I think, pretty quickly become a Dutch auction to the risk-free rate. Yeah, they hold $130 trillion or something of assets. It's crazy. 130. They literally hold like 15% of all the world's assets sit in something no one even knows. It's amazing. They do a good job at doing that, holding it. Well, think about this for a second. If a dollar is just a wrapper, what happens when you tokenize the thing that it's wrapping? So why couldn't the U.S. Treasury just tokenize U.S. debt and issue it on chain? And then what is the dollar? It's a smart contract that anyone could just drop treasuries into. And, so I think there's like second and third order effects that maybe the equity markets need to also be thinking about, because once you start tokenizing the underlying reserve asset, which should happen, like there's no reason why the Treasury needs to have, some intermediary do it. They could just have it happen themselves. And once you do that, anybody who's holding treasuries goes to a smart contract, they're tokenized, you put it in the smart contract, and out comes a stable coin. Right? And so you start to think along those lines, it's not just about even one issuer anymore. It'll be about many issuers. And it'll be about what should you pay for that? Nothing. Zero. Exactly. And so there's a couple of things to unpack with what you just said that I think are interesting. One is part of the reason why you've been able to get such adoption is because it's always been pseudo-anonymous, which means that my identity and your identity is masked, but you can see exactly what's moving and you can more or less trace it back, because there's some place that you had to get onto the world, and these companies do graph analysis and you can pretty much figure everything out. But could you put a whole economy on a chain where you don't have privacy of the transactions? Like, say you're JP Morgan and I'm Goldman Sachs, you can't have the value of our movements constantly be shown, even if you're, grossing and netting everything up, and then do that like HP to like some supplier and this thing and that. You can't, this is a very difficult thing to imagine. So somehow you're going to have to begin to add privacy in, which ironically, not having privacy is what made this reach an adoption curve. And now the next question will be, how do you enable privacy? I think that's one thing. The second thing is that ultimately these chains are programmable databases. You want that to be as cheap as possible. Right? You know what I mean? Like you want your AWS to be as cheap as possible. You don't want the token to go up. You want it to not go up because if that's what you're paying for access to the network in, you need it to be cheap. Right? And so when we talk to companies, they're always concerned about like, well, especially in payments, how to make this as cheap as possible. So you want to go cheap, you want to go one direction. On the other hand, some people say, I want to have this be as secure as possible. I want to have this be as decentralized as possible. And that's where you see people go towards Ethereum. And, of course, then there's Bitcoin, which is a whole different animal because that's really an asset as opposed to a chain.
To go back to your point, it's a really interesting point, right? If the token price is essentially the value of the slot on the blockchain. Now, the more popular it is, even if it's cheap, it still means it goes up in cost.
That's right. That's the perverse effect here is like you're just a layer on top of AWS. You want to pay as little as possible for basically the program you're running on top of AWS because every chain is running on the cloud. So, if you want your chain to actually be cheap, you don't want it to be expensive, but of course you want it to be widely utilized and you want people to hold the token and have an incentive for like using the network. So you have a very tricky balancing act. And so it's not just about price with like an L1 or an L2 or even L3s or whatever it is.
Because if the token's valuable, you get more security and people build more facilities and services on top of it. So the network's more valuable to you as well. So yeah, it's really interesting. I hadn't thought of it that way.
In the meantime, people are paying attention to XRP because it has risen above $3.20, which has sparked speculation about the possibility of it reaching for dollars. Ripple's co-founder Chris Larsen dumped 50 billion tokens last week, which caused XRP to absorb severe selling pressure. However, the cryptocurrency has since rallied with incredible resilience. Wallets that own between 10 and 100 million XRP now control over 8.3 billion coins, which is the greatest amount in a month. Large holders have stepped in to engage in aggressive behavior. A firm price floor is typically established by this amount of accumulation, which also serves as a statement of confidence from whales. In addition, network activity is increasing, with over 11,000 new addresses being added in a single day and a regular daily average that is higher than 7,500. This growth in network activity highlights the growing interest in the asset. Analysts believe that it is essential to maintain a price that is above the $3 to $2.95 support region. If this zone continues to hold and volume continues to rise, XRP may aim for the $3.80 to $4.47 range. Many people believe that XRP is entering its most profitable phase yet, which could potentially be prepared for a spectacular breakout that could exceed Bitcoin in the short term. Other factors that support this belief include excellent fundamentals, the accumulation of whales, and fresh network growth.